I've been in the room for over 20-25 investment convos in the last 2 years for businesses between $5 to $10 million in annual revenue trying to either raise capital or get acquired. And I've watched investors pass on businesses that looked great on paper: strong revenue, good growth, solid margins. But there are 3 specific things investors look for that most business owners completely miss. And if you don't have these 3 things, you're not getting funded, period. Now, if you're never planning to raise money, understanding what makes a business investable completely changes how you run your company. So even if you never plan to raise any round of funding, this video should be definitely a watch, because these 3 things are actually what makes a business scalable, valuable, and less dependent on you. So in this video, I'm going to show you exactly what investors are looking for, why most $5 to $10 million businesses don't have it, what you need to change if you want to build something that's actually worth something. So let's get started. Number 1, predictable recurring revenue. The first thing that every investor looks for is this: predictable recurring revenue. Not just revenue, not just growing revenue, but predictable and recurring. Let me show you why this matters so much. I had a client around $7 million in revenue. It was a service business, wanted to raise around $2 million to expand. Their revenue was lumpy. Big month, slow month, big month, slow month, kind of like a roller coaster. But it averaged out to be a good growth year on year. They paid 6 investors. Every single one passed. Not because the business was bad, not because the team was weak, but because they couldn't underwrite the risk. One investor told straight up, "I can't model this. I don't know whether you're gonna make 800K next month or 400K. That's not an investable business." See, investors don't invest in businesses. They invest in cash flows which they can predict. If you can't show me the next month's revenue is already logged in, you are asking me to gamble, and investors don't gamble. Here's what most business owners don't understand: revenue quality matters way more than revenue quantity. So $6 million in recurring revenue is worth 3 to 5x more than $6 million in project-based revenue to an investor. Because with recurring revenue, an investor can see what's already contracted for the next quarter. Churn rate, how many customers leave. Expansion rate, how many customers buy more. Customer lifetime value. But with project revenue, they can't see anything. They are just hoping you close deals, you close more deals next month, and that's not attractable to an investor. Here's how to evaluate your business on this. Pull up your revenue from the last 12 months. Look at the first day of each month. How much of that month's revenue was already contracted, committed, or recurring when the month already started? If it's less than 60%, you have a predictability problem. And if you want to raise money or get acquired, you need to get that number to at least about 70%. Okay, so predictable revenue is the number 1 factor. But even if you have that, investors are gonna pass and dig into your numbers looking for the number 2. And that is clean unit economics with positive payback period. The second thing that most investors look for is clean unit economics with a positive payback period. So they want to see, in simple words, they want to see you make more money from a customer than it costs you to acquire them. That's part 1. And part 2, they also want to see whether it happens fast or slow. This is the thing which most business owners miss. How fast are you able to recoup your investment in an investor? How fast you are able to recoup your customer acquisition cost? Let me break this down. Different client, around $8 million in revenue, growing 40% year on year, looked amazing from outside. Investors started digging into the unit economics and finds this. Average customer acquisition cost around $8,200. Average customer lifetime value around $16,500. So the LTV to CAC was around 2x. Now, that's not good enough. Investors want to see at least 3x minimum. But here is where it gets worse. Investors ask, how long until you break even on a customer? The client says about 18 months. Investors walk away immediately, because in 18 months, anything can happen. Customer might churn, economy might tank, business might pivot. Investors want payback in 6 months or less. This was 18, so no deal. Payback period determines how much capital you need. Here's what this really means. Most business owners think that investors care only about revenue growth. They don't. That's probably number 4, number 5 on their list of criterias. They care more about capital efficiency. Can you grow without needing constant injections of capital, constant injections of cash? That's what they are evaluating. If your payback period is 18 months and you want to grow 50%, you need massive amounts of capital upfront. If your payback period is just 6% and you want to grow 50%, then you can easily do that with even less capital. You are self-funding growth faster. So investors want businesses that don't need much capital. Ironic, but it's true. This is why unit economics matters way more than the actual revenue count. Here's how to calculate this for your business. First, calculate your CAC. Take your total sales and marketing spend for the last year divided by the number of customers. That's your CAC, customer acquisition cost. Second, calculate your LTV. Take average customer profit per year, multiply it by the average customer lifespan in years. That's your lifetime value. Third, calculate your payback period. Take your CAC divided by the average monthly gross margin per customer. If your LTV to CAC is below 3x, you have a unit economics problem. If your payback period is above 12 months, or I would probably say above 6 months, you have a capital efficiency problem. Both of these will kill an investment deal way faster than anything else. All right. We have seen number 1 and number 2. You need a predictable revenue and clean unit economics. But there's one more thing that investors look for that most business owners completely overlook, and that is financial systems which works without the owner. And this is where majority of the businesses that pass criteria 1 and criteria 2 fail. So if you are the person who knows where all the money is, investors don't want your business. Let me show you why. So this is the question investors ask. If the owner disappeared for 3 months, could this business still manage cash, make financial decision, and stay profitable? What they are really asking is this a real-time? Is there a real-time financial dashboard? Does someone other than the owner review P&Ls weekly? Are there clear expense approval processes? Is cash flow forecasting automated? Can the team make financial decisions without the owner? This is the most important question an investor asks. And if the answer is no, you don't have a business, you probably have a high-paying job. And investors don't fund job, they fund real businesses with clear SOPs. I watched a deal fall apart over this exact issue. Around $9 million in revenue, great margins, strong growth. Investors was ready to write a $3 million check. During due diligence, they asked to see the monthly financial review process. The owner pulls up the Google sheet. He updates himself every month by his hand manually. So investors ask, who else has access to this report? The owner says, just me. I'm the only one who understands the numbers. Deal died within a week because the investors realize if the owners get hit maybe by a bus, nobody knows where the business stands financially. There's no system. It's all in the owner's head. They weren't buying a business. They were buying a person. And you can't scale a person. You can only scale a business. If you're the only one who can read a P&L, make budget decisions, or forecast cash, your business isn't worth what you think it's worth. Investors value systems, not superheroes. They want to see automated financial dashboards updated daily, someone other than the owner running financial meetings, return processes for expense approval, cash forecasting that's systematized, not a guesswork, financial reporting that doesn't require the owner to explain it. What investors want to see: real-time financial dashboards, weekly management meetings with financial review, 13-week rolling cash flow forecast, clear budget versus actual reporting by department if you have departments in your company, documented expense approval process, monthly board level financial packet, someone other than the owner who owns the financial functions as well, apart from the owner, probably in a supporting role. What kills deals? Owners update spreadsheets manually. No one else understands the P&L. Cash forecasting is, I think we will be fine. Financial decision requires owner's approval. No documented financial processes. Reporting is explained verbally, not systematized. If you have more cross than ticks, then your business is not investable yet. Here's the test. Could someone step into a business tomorrow and within 30 minutes, just 30 minutes, know how much cash you have, what's your burn rate, which products are profitable, where is your money going, and what financial decisions need to be made this week? If someone can do this within just 30 minutes of stepping in your business, then your business is investable. If the answer is no, you don't have financial systems, you have financial tribal knowledge, and tribal knowledge doesn't scale, it doesn't get funded, and it doesn't increase the valuation of your business. So that's the 30-minute test. Can anyone walk into a business today and find out what's your current cash balance? What's this month's burn rate, product profitability, outstanding AR receivables, upcoming major expenses, this week's financial decisions needed? If no, your system isn't investor grade. Build systems, not dependence. So those are the three things. Let me bring it together again. Number one, predictable recurring revenue. Number two, clean unit economics with positive payback period. And number three, financial systems that works even without the owner. Now, here's the thing. Even if you never plan to raise money, these three things are what makes a business scalable, valuable, and less stressful to run. Predictable revenue means you sleep better. Clean unit economics means you grow profitably, and financial systems mean you are not trapped in the day-to-day operations. So whether you are fundraising or not, these are the markers of well-built business. Build these even if you never raise money. They are what makes business investable, valuable, and scalable. Now, most founders at $1 to $3 million aren't stuck because of strategy. They're stuck because they are making high stake decisions without clear CFO lens. This is where CFO thinking comes in. Not spreadsheets, not reports, but how to see what actually matters, ignore what doesn't, and make decisions that moves the business forward. I'm building a small room for founders who want to stop guessing and start deciding and acting like a real CFO. If that's you, check out the link in the description. Now, even if you know what makes a business investable, you could still be making three financial mistakes that most business owners between $1 to $10 million in annual revenue make. So if you want to avoid those financial mistakes, watch out this video next.